So there was a wild ride today, but these are the closing numbers on Wall Street. The market started out down on the open, but there was a massive surge after President Trump did announce he was pausing most tariffs. So what does all this mean? We're joined now by Michael Orlando. He's the director of the J.P. Morgan Center for Commodities and Energy Management at the University of Colorado, Denver. So let's talk about the tariffs. This is a temporary pause, but clearly it went over well, at least on Wall Street.
For sure. I think of it as a cooling off period where hopefully, and what I interpret from the market's reaction from investors in companies that are exposed to tariffs, is that they all think, wow, more people believe in the basic laws of economics and gains from trade than maybe we were starting to expect. So this is good news.
Yeah, so when we hear this 90 days though. Is that like, should we be concerned? That like 90 days we're going to be back at this?
Well, it's hard to forecast any one person's psychology, but one thing I do feel is important is to not only look at equity markets, so the stock market, but also look at the bond market and specifically the cost of borrowing for the U.S. And yields typically when people worry about the real economy and move out of stocks, they move into bonds because it's a safe haven.
Safe, yeah.
But starting at the beginning of this week, the yields on our debt, the cost of our borrowing actually started to go up. And I think that provided a reality check. Regardless of what the nuances are of different people's opinions, do I believe trade and possibly bilateral trade deficits is good or bad? When you look at us increasing our cost of borrowing dramatically over the course of 2 or 3 days, that provides a reality check. So I feel like that is going to continue to be a threat to not coming to some kind of cooperation and agreement with many of our trading partners.
So I think the markets like it when it goes like this, and they don't like it when it goes like this.
No.
But they hate it when it goes like this. And it looks like now we're in more of a flinching type of economy that really makes people uncomfortable.
And there were measures of volatility, of implied volatility in the stock market that actually did dramatically shoot up last week and through the weekend. Again, I think the reason is when you look at these tariffs, the way they were constructed was not really reciprocal to any particular tariff. It was more like just in proportion to trade, which means it kind of implies the administration didn't think trade was good, which leaves many investors wondering, how the heck do they think?
So people I know are really starting to think about when they buy a car, a refrigerator, a big screen TV, like I have to buy it now before this. So where does the person at home sit right now? Not the big investor, but the person at home.
Yeah.
Is this an impact?
I mean, I think what you're going to see is a lot more calm talk, a lot of people claiming success through whatever particular strategy they've chosen. So this is where I'm going is I don't know if I would rush. My wife would rush because she ran out and bought an iPhone yesterday, but
did she
I
really?
wouldn't rush. So I think what we're going to see is because over the last 20 years, China has developed so many other trading partners around the world. The way that markets are interpreting this pause or sort of reduction in tensions on trade by the U.S. is that now they do trust we do respect the gains from trade logic of 200 years of economics. And the reality is that most of those goods from China are now just going to have to go through other pathways in the supply chain to get to the U.S. to be able to avoid these very excessive tariffs.
Is that like laundering?
You could think of it sort of like laundering your goods, laundering your iPhones. It might be.
Michael Orlando from UC Denver, we appreciate you taking a few minutes and shedding some light on what's a difficult, confusing time for many people.
Thanks so much.
Thanks for having us. We'll be